Well, hello everyone. Good morning, afternoon, or evening from wherever you are tuning in from. My name is Ben Hillary. I'm Managing Director of Commodities People, and really a huge welcome to the second webinar of Commodities and Energy Risk Online, which will be exploring the critical and deeply timely subject of scaling without losing control in volatile commodity markets. In the commodity markets of 2026, and come to think of it, for much of the last 6 years, volatility isn't just a periodic visitor, it's our permanent environment. As geopolitical tensions, most recently with the Iran crisis, create gaps in the market overnight, the pressure on risk infrastructure often reaches breaking point. So the central question for today is really simple but high stakes. How do you scale at pace without losing control? We've all seen firms that appear robust during calm periods, only for the stress moments to reveal deep structural fractures. Is your organization truly in control, or are you just benefiting from a streak of good luck? We'll be moving past the theory to really address the ultimate balancing act. How do you empower traders to move at the speed of the market without outrunning your control framework? We'll be breaking down the technical friction of scaling under pressure, from the blind spots in automated risk engines to the sheer operational bravery needed to migrate a live trading desk. So whether you're defending the P&L or managing the code, we're looking at how to build infrastructure that turns volatility into a competitive advantage. I'm delighted to, absolutely delighted and thrilled to be joined here by an exceptionally knowledgeable panel, bringing a really wide range of experiences and perspectives to the session. So delighted to welcome Dr. Sadar Abdul Rasheed, Executive Director for Commodity Risk Control at Savola Group. Jonathan Horn, founder and CEO at Treefera, Norbert Verhagen, managing director at RadarRadar, and Yefreed Ditta, director of consulting at Yefreed. This session will take the form of a panel discussion followed by Q&A. So on that note, throughout the webinar, please be posting your questions in the Q&A box and upvoting others of interest. Time permitting, we'll be picking the top few at the end of the session to put to the panel. Also, do make full use of the chat channel for any comments you want to share with the panel and the audience, or even just to introduce yourself, say hello, and where you're dialing in from today. So, without further ado, I'll kick things off with the first of our 3 audience polls. To set the scene and to better understand your thoughts on the present operating realities, drum roll. Mena, if we could have the first poll, please. Okay, first poll. During major market shocks, such as what we're presently seeing with the Iran crisis, where did you get your final truth for management reporting? Is it fully automated from your CTRM and risk system? Is it a hybrid of system data and manual sanity checks, a custom-built Excel sheet, or end-of-day, next-day reports? And if we can close the voting in 5 seconds, 4, 3, 2, 1. Mena, could you show the result, please? Okay, interesting. Probably very interesting, actually. I think it's probably pretty much in line with what we would expect. So many thanks for that. Very interesting, and thank you, audience. So now, time to discuss. Panelists, could I ask that when each of you answer your first question, you just briefly introduce yourself, your company, and your interest in the subject of today's panel. So first question, why do specific control issues only seem to surface during stress moments like market shocks? And what distinguishes a well-controlled commodity organization at scale from one that really is just lucky? Sadar, if we could start with you and then go to Norbert on that one, please.
Thank you, Ben. Myself, Dr. Sadar Abdul Rasheed. I work for Savola Group based in Saudi Arabia. So basically, I've been in this industry in commodity risk management from last 20 years in the MENA region. in various roles, especially front, middle, and back office, dealing with different commodities, agriculture, metals, energy, space in industrial hedging. So it was a very interesting question because now we are almost in the same market dynamics where we are discussing today this webinar. The question was around the weakness and control and stress, right? So I will start with one saying: luck hide in weakness, weak controls. Means the luck is always hide in the weak controls, but the stress expose them. That's the thing. The stress is a villain in always in like a movie in the market. It will come. It will come from geopolitics. It will come from supply and demand. It will come from the speculative moves from the funds and whatever it is. But if you have a proper control in place, you have always managed that control before it happened, before the unexpected event happened. So the controls are very important and it has to be done a very big stress testing. That's what we have done in risk management is always a session itself for the stress testing, right? It will come with the expected short loss or value at risk or whatever the measures you do in the market. But the same as I said, sometimes the luck will hide your weak controls, but the stress is always expose it. So similarly, depends on the organization to organization and industry to industry. The risk philosophy will be addressed, and that can be addressed and managed to either enterprise risk management systems or proper inbuilt risk management systems starting from price risk or market risk. So this is a very interesting point, and volumes and volatilities and correlations will always change. Sometimes the market move, and we have seen the gold market how it is picked up, and now it is coming down, and the people are in an unpredictable mood. Do I invest in gold or no? Then now we are seeing the inflations and inflationary pressure coming from the crude oil prices. The market is predicting $200 in 6 months and $120 in one day could be possible. So the time frame is this real play, real game. The volatility is the measure for that. So that's why the organization to organization we need to build the proper controls in place, either way of CTRM systems or the ERP systems. Like we have the poll questions, the people are saying that hybrid, but unfortunate thing is I have seen again the 24 percentages goes to the Excel. Means some portion are still using the conventional methods. So you have to arise this question yourself. Your organization is agile or to handle this kind of situations. That's the question to the panel. And I'm just going back to Ben. Back to you, Ben.
Thank you. Norbert, your thoughts on that?
Yeah, first short introduction as mentioned by Ben. I'm managing director at RadarRadar, responsible for business development. For the people who don't know RadarRadar, RadarRadar is an out-of-the-box commodity data platform designed for the commodity industry. The heart of Radar is what we call the Radar engine. And it's a tool which is able to ingest, normalize, and harmonize all relevant commodity data of our customers. So in many cases, that's multiple CTRMs, ETRMs, ERPs, market prices. And what we do with that is create a solid global one source of truth where numbers are trustable. On top of that, we provide all kinds of business solutions, starting with, of course, risk reporting capabilities, acquisition reporting, mark-to-market, P&L, risk, stress testing, value at risk, limit monitoring, counterparty risk, option analytics, and then we have solutions for the processing industry, bulk processors, but also fast-moving consumer goods companies, where we much more focus on cover reporting, cost management, and in the end, we create a forward-looking margin for those customers. So, short introduction of Radar. Now back to the question. I think, and we see it a lot still in the industry, system landscapes are fragmented. And therefore, in many cases, also reports are fragmented. Every department has its own reports, controllers, traders, risk, and so on. And as we also saw in the poll, not everything is per se completely automated and trustworthy. Many Excels, Power BI, etc. And in particular, in stress situations, that sort of ad hoc or distributed landscape is suddenly exposed. Suddenly, there are going to be discussions of what the actual exposure is. If you look at well-controlled organizations, they don't discover their exposure during a shock. They already know it. They trust the numbers, they can explain them, and there's no debate on the numbers. They're well prepared for the event, for the shock, and they're ready to act. So I think that is the big difference between companies which are well controlled and companies which still have a path to go. Back to you, Ben.
Excellent. Thank you for that. Well, next question. When volatility spikes, there is often a tension between, I suppose, trading agility on one hand and risk control on the other. So in the views of the panel, is it possible to have both in real time, or is one always sacrificed for the other? Yefreed, if we could go to you on that one, and then Dr. Sadar, we'll take yours.
Yes, hello everyone. My name is Yefreed Ditta. I'm the Director of Consulting working at ValueCreate. For those of you that don't know ValueCreate, we are a system and data landscape consultancy focused on energy and commodity trading companies. We are located globally in the US, in Europe, in India. I work out of Switzerland and have 20 years of experience in the energy industry, and really pleased to be part of this panel. So to your question, Ben, as I think you mentioned it earlier, right, is more of a balance rather than a sacrifice. However, there are some clear guidelines that depends from company to company. So I think there are three main aspects. One is, of course, the nature of the market. So for example, if you don't have an intraday market, okay, you can have real-time visibility, but if you cannot act upon it, then the needs is somewhat reduced. The second is, of course, the risk averseness or the risk appetite of the firm. So if you're more conservative, of course, you will tend to favor a little bit more the control over the agility and the other way around. And last but not least, your technology capabilities. So it's undeniable that you need technology at the backbone to be able to achieve both trading agility and risk and good risk controls, good data quality, etc. Hence, those three aspects are, let's say, create a three-dimensional view of where you are at along those three dimensions. Back to you, Ben.
Thank you. Dr. Sadar?
Yeah, thank you, Ben. And see, this is a very interesting question because the agility and risk control, right? Because the agility is always achieved when the limits are in place, the usage is there, the proper valuation and exposure calculations are there, then the agility will come. So I can say that the agility will come from preparations, right? Then the control is the other side, yani that is the permissions, and it is control is always a reaction. Okay, it's a reaction, the action and reaction. So actions, we set up the limits, and agility is in the organization by setting up the risk philosophy, as my colleague mentioned. The other one is a reactive action, because the controls will come from the reactions, and that is the protection, that is the hard lines for the action to be stopped, like stop losses we have, limits we have. But the thing is, it should be balanced properly in the sense that wherever the market situations will change according to the nature of the reactions will change. That means we cannot take it as granted for everything. Sometimes current situation like geopolitics, okay, it is a multiplier impact. It will be starting from the commodity movements. It will create an inflation. It will create a deflation of the currencies, and you have seen that, and how big movement has happened in the US dollar index versus the other Asian currencies. So these are creating inflations in the country, and the cost is going up because of the freight premiums, and war premiums are increasing, the freight rates are going up, and some of the shipping lines are not ready to accept the shipments. So we need to feed the world either in commodities in terms of food as well as in other essential commodities. We cannot stop that business. The commodity has to move from one place to another. So these kind of situations, the impact is a multiplier impact. So it will create a disaster and chaos, and it will create a lot of other problems in the countries as well. And the countries like in India and Pakistan and Nepal and Asia and China are also facing these issues on in a very, very big impact manner from day to day life. Okay, so as per we do the proper, I go back to the first thing I mentioned about the stress testing, Annie. Stress testing is very important because stress testing is expect the unexpected. So we need to include our stress, all the variables that are having a very big impact in the long term, whether in a linear or non-linear level. So there is the game change actually. That is a game planner actually. Game change as well as the planner actually. So the stress testing has that importance, and the proper balancing between agility and risk control. These are the two things we need to monitor very dynamically up to the market situations change. That's all from my take, and back to Ben.
Excellent, thank you. Well, next question. Let's talk about automation. Does more automation actually reduce blind spots, or does it actually create more new, more complex ones that are actually harder for a human to spot? Jonathan, if we could start with you on that, and then we'll go to Norbert, Sadar, and Yefreed.
Perfect. Thank you, Ben, and a pleasure to be here with you and my fellow panelists. So just a brief introduction. I'm Jonathan Horner. I'm founder and CEO of Treefera. What is Treefera? It's a AI native data platform, and we specialize in surfacing and originating data on ags and softs. That's grains, coffee, cocoa, palm, all sorts of different commodities around the world. And I'm here because I think the biggest risk and biggest blind spot really to a lot of commodity trading is not so much the systems. There's some extremely powerful and great systems around. It's actually more the data that you're feeding the systems. That's my kind of worldview, if you like. So does more automation reduce or increase or create new blind spots? There's a lot of, and many of the people in this audience will know, and panelists also experts in this area. There's a lot of fantastic automation that's really improved the transparency into all that's going on. So I think that's very commendable. I think where it hits a limit though is not so much the automation and the amazing things that it can do, but more the data that we're feeding that automation. So if you're taking commodity risk data as an example, and you're using government reports, what your brokers say, prices, market kind of information, there's still a blind spot, which is really what's going on the ground. And what we spend a lot of time doing is looking at real-time or near real-time data on what's actually happening on the ground for food, so ag and soft commodities particularly. So I'd say the kind of real blind spot is not the algorithms as such, it's more the upstream data and the availability of that data on the production side. So where you see emerging risks and stress in the system and can kind of get ahead of that before you get market consensus and then kind of the extreme swings in the market.
Thank you. Well, Norbert, your take on that. You're on mute. We said it would happen to someone, and well done. It was.
There we go. There we go. Thank you. So yeah, automation reduces blind spots if done well. And what we see in the market, and we talk to a lot of companies. Many companies embarked on in-house automation projects, resulting in first it were data warehouses, then data lakes, and now everyone is looking at AI. there is still I think a quite big problem in the market, and that is that these in-house built systems often are considered black boxes. So you should ask yourself the question, if a position is wrong, will you see it in your reporting layer? And if there is a mistake, are you able to easily see where that mistake comes from? Is it something, is it a trader who entered something wrongly in your CTRM? Was it the data extraction from that CTRM? Was it the ingestion into your risk layer? Was it business logic which was applied? Was it, is it in your reporting itself? And had that whole exercise of finding errors and making sure that no errors happen is often challenging. And so if I would define good automation, you need to have good data governance in place. You need to have complete governance, complete transparency of the data, and you need to have complete traceability of the data. Every number you see in whatever report, you should be able to trace back to the source. So I would say with good automation, basically everything should be explainable and auditable. Unfortunately, I think with Excel reports and Power BI reports and all these data warehouses and data lakes in place, I think the automation part is still lacking. Back to you, Ben.
Thank you. Dr. Sadar?
Yeah, see, automation is a good thing, especially we are living in a world of artificial intelligence, and we have too many developments every day and every second. There's new things are happening in the world, and we need to accommodate and we need to innovate our business process. That's a good thing. But the thing is, actually, as my fellow panelists mentioned, it creates a new blind spots always, especially in the area of data assumptions, model drift, and there are certain things and exception handling. There are certain exception handling situations come in terms of risk and the market is concerned. There, all the automations may fail, and always in the CTRM system will capture almost 70%. Even the 30% exception handling, we need to operate the business. Scenarios will come up and go. Suppose in our business in sugar refining as well as in oil refining itself, there are exceptions. Some customers will come and they will do the mispricing and we need to accommodate them. Then the automation stop me doing that. So the exception handling is very, very, very important in automation. And that's why we need to have a proper governance, as my Norbert mentioned, the data governance structure and data structure and architecture, how we are building it. And it shouldn't stop us from doing business and running the EODs and running the P&L reports and everything to accommodate. So that's why we need to have a big view on that. Only the automation change the risk locations, not that doesn't remove the risk. Actually, it will be move from one location to another location. Like Jonathan mentioned, the algorithms maybe, the assumptions maybe. So these are the things altogether in the automation. There is a dark side of automation, what I have seen and experienced. Back to you, Ben.
Yeah, thank you. The dark side of automation, I like that. That's Yefreed, could we get your perspective on that, please?
Yes, I mean, there is very little left to say. I was like, guys, stop saying my point. Anyway, no, actually, there is one thing I would like to add, definitely, and I think it's the concept of regression. So across my whole experience, right, you can have the perfect data lineage, you can have the perfect governance, quality checks, constant monitoring, but if you do a change on your model and don't do a regression to make sure that your outputs are still consistent with whatever you were doing before, of course you will create problems down the line. And this applies to models, pipelines, whatever you want to call it. So having a good regression practice or methodology, whatever, or that's kind of institutionalized. Some people consider that as part of the governance. It could be there is not, but nevertheless, I think that's the most common source of mistakes I have seen throughout my career.
Thank you. Next question, interesting one. as we move towards as we move toward autonomous risk engines, what is the one specific risk metric or scenario where you would never trust an automated system to make the final call without a human lead's sign off? So we'll go with Sadar and then Jonathan and then Norbert for that, please.
It's a very interesting question and very relevant question, right? Because people want to run automation everywhere. See, the first thing is that anything is irreversible, right? Irreversibility is must, my take on that, where he need human ownership. The human sign off is nothing, it is an ownership, right? It's an accountability, because we need to keep accountability, because I'm generating a report. I am fully accountable for that. Okay, I cannot blame on automation for that. Okay, then we need to have a human touch, and should have a 2-level or 3-level of reconciliation mechanisms. But back to the question, the main focus question about the one thing, I would say basically the trail risk and irreversibility, that is completely required the human ownership. Back to Ben.
Thank you, Jonathan.
Yeah, so actually just building on the good doctor's answer, really. So I would say counterparty credit exposure, particularly during an emerging kind of supply side shock. So I think you can see production areas under stress from things that we look at. You can see that building up in some country of origin. There's downstream implications, they're cascading, might non-linear effects. So all sorts of which counterparties are overexposed and all questions that are really important in that space. While systems can help you understand the numbers, I think when you're thinking about counterparties, whether to restructure, margin calls, whatever it is that's necessary, I think that's where human judgment about relationships and in-depth knowledge of clients and counterparties is really important. So I would say, from my perspective, human in the loop is essential in that process.
Thank you. And Norbert. Oh.
I'm fully aligned with my previous speakers. I think humans remain essential. Assumptions need to be challenged, and external context matters. In the end, models don't bear any responsibility, and people do, right? So very simple.
Good, thank you. Well, ahead of the next question, let's go to audience poll 2. So, yes, okay, there we go. So, if your firm closed a major acquisition today, how long would it take to integrate their positions into your real-time risk and credit framework? Let's assume for this scenario that they're at the same level as you are of advancement. Would it take hours, plug and play, fully API ready, days, standard onboarding, weeks, significant manual reporting? Or if your company did a major acquisition, would this be a months and years long integration process, and they'd run a siloed system for now? And we'll close the voting on that in 5 seconds. 4, 3, 2, 1. And can we see the results, please? Yep, interesting. Congrats to the hours vote, but I very much expect it to be more geared towards that bottom half of the poll. So really interesting. Leads us very nicely into the next question. So if a trading desk triples its volume overnight, what is the first technical point of failure? And what are the early warning signs that an organization's scale is outstripping its control framework? Yefreed, if we can go to you on that one, and then we'll go to Sadar.
Yes, unfortunately, it's the ETRM. That's what I have observed on my experience and also experienced myself. Even if there are claims that we can scale up to X amount, when it triples suddenly, there is something you need to fine tune. Either you don't have the big server enough or enough cloud space, whatever. There is a level of adjustment that you need to do, at least as of now, especially when we are talking about physical markets. financial markets, futures and so on, you can to a certain degree scale in an easier way, but definitely physical markets will be a bit of a struggle. And I think the part when early warnings is, as I always say, how long your end of day runs. Like if your end of day runs smoothly, it's a reflection of your setup. If it takes ages, is definitely a reflection of how streamlined and how well suited you are for your purpose, irrespective of the size of your portfolio.
Thank you. Sadar?
Yeah, it's a very interesting question because I experience sometimes in the market every day. I don't want to take the name of a big CTRM company. I used to get that email. Sorry, we have a delay in delivering your reports because of some issues. I used to get this email. That's the same thing, it's the first thing is the data flow and control. Okay, because if I tell my situation, because we used to hedge in the market and we used to hedge it through the brokers sitting in London and New York and derivative brokers, and they execute the trade and they will come out with the statements and the recaps and every day. Sometimes all these are managed by the CTRM backend system they have. They have using Ion and they're using ACA or whoever is in the market share. But sometimes it will have the same issue, the trade flow and the big movement happened on that day. The next day there will be, you can expect some kind of email from our broker saying that there will be a delay in sending our reports. Okay, so it will stop me from doing my things. I need to have my EOD report on what happened yesterday and what are my margin calls and where are my margin positions and exposure report. It all will get delayed. Then what is a sideline for that is the manual fix. So this has become a temporary, but that's become a ongoing process. Then why we need all these things? So this need an ecosystem. Okay, that's why we are here. We are sitting in an energy and trade commodity risk conference, especially the conferences. We have an ecosystem. It's not only the industry require a CTRM system to monitor. That ecosystem need to be built and become an agile. In one failure in that ecosystem will have another impact on the other. The failure in the capturing the data, it will lead to a control failure in the business side is concerned. If there is any delay, it will give me an exposure report to be different because we don't have the time. The market close at the evening and one part of the world and another part of the world, it is a day. If you consider the Asian and US market and Europe market, it's upside down. So we need to have a very agile things and we don't have any compromise at all. Okay, that's the big failure in the entire decision-making process. That's all. Back to Ben.
Thank you. Next question. What is the biggest barrier, in the view of the panel, to achieving a truly unified view of market, credit, and operational risk? And how do leadership teams know when they actually have control rather than, just faster reporting, really? Norbert, if we could start with you on that one.
Yep. Thank you, Ben. I think the biggest barrier is not per se technology, but it's the operational alignment around one economic reality, right? What we see often in market, credit, operational risk, but also other departments or even people in different countries, they don't use the same definitions for the same things. And there's always this distributed reporting systems. How does the leadership know whether they're really in control? I think we should all ask ourselves, what if my CEO asks the same question to different departments in my company? How long will it take to get the answer? And will the answer be identical? Let's say he will ask, what's my position in Brazil, to market risk, credit risk, to a trader, to his CFO, and to a controller. If he gets the same number and he gets it instant or near real time, you're in control. If he gets different numbers from different people, different departments, or whole departments are in panic mode, you have an issue, right? So I think that's a good measurement for how much an organization is in control. Back to you, Ben.
Thank you. Sadar?
Yeah, it's basically the fragmented ownership is the biggest thing, The ownership is very important. The ownership and discipline is very important in risk decision making and in their system. Okay, we can make a speedy decisions without alignment that will create a lot of confusions. So we need to architect the risk philosophy in the organization, and we need to cascade it into a proper departmental level, not in silos, in a integrated and without any fragmented ownership. So we need to have a credible reporting system. We need to have a credible reporting for the decision making immediately rather than any other further delay or any other further obstacles. So that's the way the organization has to be build their risk and risk decision making systems. Back to you, Ben.
Thank you. Jonathan, your thoughts on that?
Yeah, sure. And actually, just building on the previous two answers, which I completely agree with. So I'd add a kind of third dimension to it, which is really around kind of data latency and mismatch in that. So market data is coming on a ticker, so that's milliseconds. Your kind of credit data maybe on a quarterly basis. Operational risk data, it's really reviews and often kind of incident reports after the fact. So when you're trying to consolidate a view of reality, as Norbert said, that everybody kind of agrees on, that's difficult because of that latency and mismatch. So building on the kind of Brazil example, and again, from our perspective, always thinking about, ags and soft. So in the case of Arabica coffee, late May, early June frost, getting the ground reality of what impact that's had from a kind of upstream production point of view and where that risk is then going to emerge. It's kind of simultaneously a market credit and operational risk. And that's where those things come together. So it's not separate, it's in addition to what the two previous speakers highlighted.
Thank you. And Yefreed?
Yes, as everyone has mentioned, I think fragmentation was this is by nature fragmented, right? As Jonathan mentioned, credits for the past, market is kind of for the future. The latency or the frequency when the data arrives is different. They reside in different systems as well. Maybe the market risk will tend to be more ETRM / front office tools, but credit risk might be SAP or another. Also, organizationally, sometimes credit risk is with finance, market risk is in middle office, operational risk is in logistics, IT, etc. So this is fragmented by nature. So which means that what needs is integration or consolidation, and that is what many organizations lack. That consolidation, not only from a technologically speaking, but also from common risk philosophy, as Dr. Sadar mentioned as well.
Yeah, excellent. Thank you. Well, that actually leads us very nicely into our final audience poll. So there we go. Question is, how is operational risk currently positioned within your trading infrastructure? Do you have a dedicated formal operational risk function? Or is it secondary responsibility within market or credit risk, largely managed within the back office or IT? Or is it currently just quite an informal or an ad hoc process? And we'll close voting in 5 seconds. 4, 3, 2, 1. And if we could see the result, please. Okay, yeah. Interesting, quite well spread there. So, moving into the next question, we'll send this one your way, please, Jonathan. So in 2026, we're more interconnected than ever. If one of your key data providers or a cloud service goes down during a period of extreme volatility, how does your current architecture have a manual fail-safe, or are you effectively out the market? What's happening?
So, and as we all know, this is not really a hypothetical question. So we've luckily as human beings, we have a great capacity to forget painful experiences. So I would say, I'll give you a couple of examples. So January 2025, FuseNet, which is the global food security early warning system, was shut down effectively. NOAA, which is climate research, faces significant budget adjustment downwards. So all of these sources that we've come to kind of rely on, and we're perhaps either explicitly or implicitly completely wedded to for a lot of our downstream processing and understanding of the world, they're often subject now to disruption, technical disruption, cyber disruptions increasing on the daily because of improvements in AI technology, as an example. So all of these things are happening more frequently. Real world kind of nature-based risk, geopolitical risk, it's all happening much more frequently, and often these events are more extreme. So I would say, from kind of our perspective, certainly, you need to have, it's absolutely essential to have different data providers. You need not only a kind of some fail safe, so some manual switchover, you need to have live feeds that come from different sources and can safeguard you in these times of volatility. Just from my previous roles, I used to be in investment banking at Citigroup and then JP Morgan. We had an occasion where there was a big dislocation in the market, and this happened to all of the banks in Canary Wharf because somebody put a mechanical digger through a large fiber optic, and that put everybody in Canary Wharf out of the market. So these things have to be considered. I think these events are getting more frequent, and so therefore any kind of risk management policy should address them, and they're kind of urgent in my opinion.
Thank you. Next question we'll take to Yefreed. This is one that I think fills many full of fear. What is the single biggest risk to live trading when a firm is switching its core architecture midstream during a phased migration?
Yes. So, it took me a while to understand the question. So I hope everyone in the audience knows. It's basically you have live trading. Suddenly you have some sort of middleware and you are switching it from one to another or another critical component in your trading infrastructure, just to rephrase it in case it is clearer. And to me, the main problem is when you create a lack of accountability or / escalation path, because that creates a limbo or a vacuum where you have two systems concurrently running, doing whatever function. And if you don't know when to go to which team, or if it goes to the same team, who is responsible for what, and you create that uncertainty where people will be asking around and, okay, who's responsible for it, who's responsible for that? That's basically the recipe to failure and to negatively impact the live trading. So if you are doing something like that, be very clear towards the users, okay, who and internally for what is being supported where. So whenever there is a problem, people will know how to act.
Thank you. Our next question, our penultimate question, will address budgets. So ahead of that, I'd like to ask our audience in the chat to just type the one area of risk infrastructure that you might see as being most often the weakest link. And while you're doing that, I will put the question to the panel. So to the panel, for the risk leaders in our audience, if they have a limited budget this year, how should they spend it? Should they spend it on better data, better systems, or better implementation support? Yefreed, if we could start with you on that one, please.
Yeah,
Me?
well, this, I think, not where to spend it, but the target should be better data, because that encompasses all your different, so you need better system, you need better implementation, better organization. So if you set better data as a target, you can somehow spread that budget across some of this implementation, but that you can achieve that target. That's what I would say is a way of moving forward.
Thank you. Norbert, your thoughts on that?
Yeah. I agree on work on the data, the quality of the data. My advice would always be don't fall into the trap of developing in-house because the budget is limited. I work with the experts in the domain, work with proven technology, and this will always have a much better return of investment than a short-term spaghetti code solution.
Thanks, Jonathan.
Yeah, so and out of respect for my fellow panelists, so implementation and systems, of course, always very important. I wouldn't doubt that for a moment. But ultimately, you're trying to get insight, and that is reliant on really good quality data. Fundamentally, that's what you're trying to serve up to the human being making the decision. So I would always say better data. And I think one of the big kind of blind spots is the data at first mile. So technology's moved on, and we can now get data from places and originate it in ways we couldn't even 5 years ago. And I think that should be a significant focus. It gives great market advantage.
Thank you. And Dr. Sadar?
Yes, of course. The technology by potential, but the implementation decide the outcome. Okay, I'm talking about a normal environment where data is flowing properly, but the important game is the implementation. If you have everything and your implementation is failure, there is no say in that. Okay, so the implementation, as I mentioned, other panelists, I go with the implementation. That's the key in any projects and CTRMs or decision making systems. Back to Ben.
Excellent. Thank you. Well, final question, and we'll do this as a bit of a quick fire in a few sentences or less, ideally, as we're coming up to time. So we're taking out the crystal ball. We're looking towards 2029. What is the one competitive edge today that will be a basic requirement for survival 3 years from now? Jonathan, what do you think?
I think 2029, the world's getting kind of more volatile in all sorts of different respects. I think all of that is amounting to kind of more risky and volatile situations. That has a great commercial opportunity as well as kind of potential downsides. So I don't want to be at all negative about that. So I would say using modern technology to refine our insight through data is kind of key to us getting ahead of that volatility. So getting information advantage, it used to be the case that we could just rely on government sources and kind of broker reports. That's no longer the case. Alternative data is absolutely critical to be able to look ahead.
Excellent. Thank you. Dr. Sadar?
Yeah, the one thing is I believe it's a control transparency and explainability in the organization, because we have controls, but that should be in a transparent manner. So that's the key in requirement to survive in coming forward, because the market is getting more and more. The risk is getting in different dimensions, and now there is a new risk is there. That is the AI risk. So we can't ignore that, because more and more we go into automation and artificial intelligence and algorithms, the risk is involved in that. So that is also a new dimension of risk management in the risk in AI. So the things are progressing, but are getting more complex on the risks arena is concerned. So the explainability and transparency and discipline in controls are very important moving forward. Back to Ben.
Thank you. Norbert?
Yeah. So the competitive edge today should be defensible real-time exposure and risk insights across the enterprise. I think what we all see is AI and how that is developing. But we need to also be very clear that any AI model needs high quality data. And there is an enormous risk building complex models no one understands, which takes data which is not right. Classic garbage in, garbage out. And so AI, super exciting, but make sure that your data foundation is trusted and defensible. That's it.
Absolutely. And Yefreed?
Yes, to me is what I would call software and modeling development power. So today, if you have like some good PhDs that can, write advanced models that, compared to others, you have a competitive edge, or if you have a lot of development power that allows you to churn tools and automations very quickly, this will be a normal commodity. Maybe not the modeling, but definitely the development will be a normal commodity in already next year, where anyone with some good AI agents can buy codes and many things. So this won't be a competitive advantage anymore, but something that you need to essentially switch to be able to keep up with the speed that could be achieved now.
Absolutely. Well, that brings us to the end. I'd just like to say a huge thanks to our panel for sharing their insights today, and to you, the audience, for joining. Now, the recording will be sent via email in the next few days, so if you found it of interest, do please share with your colleagues and your wider network. And at the same time, if I or any of the panel can be of any assistance, please do drop us a line, or please do connect via LinkedIn. So again, many thanks, audience, panel. You've been fantastic, and don't forget to join us for tomorrow's sessions, which will focus more deeply on risks related to energy, power, and renewables markets, with speakers from Repsol, Serena Energy, EnBW, M&D, Energy Traders Europe, and many more. So don't miss it. Many thanks, everyone, and have a good
Thank you, Ben, and thank you, fellow panelists. Have a nice day. Have a nice evening. Thank you.
Thank you,
Thank you,
everyone.
everyone.
Thank you.
Bye.